Kitco News special coverage of the Mining Investment Event of the North is brought to you by West Red Lake Gold Mines.
Hey everyone, welcome back to Kitco News. I'm Jeremy Saffron. We're coming to you from beautiful Quebec City, Canada. Of course, here covering the mining investment event all week long. We're going to have some great guests, so stay tuned. Now, the room is filling up and there's some excitement in the air because gold is again above and holding above $3,300 after briefly hitting past that $3,400 earlier this week. In silver, just surged past $34 an ounce, and that's its highest level since early 2012. And for the first time in weeks, mining stocks are now catching a bid. The GDX is up nearly 5% in 2 days. Meanwhile, if we zoom out on the macro front, the OECD has slashed its global growth forecast, blaming President Donald Trump's tariffs for stalling investment, pushing up prices, and then dragging the U.S. GDP down to 1.6%. Now, that warning helped push the dollar to its steepest decline since February, while gold posted its third straight weekly gain. Now, meanwhile, the mining sector is caught in a different kind of volatility. Barrick's billion-dollar mine in Mali remains shut, with a court again delaying its ruling. And despite record cash margins, gold miners continue to trade at steep discounts, and silver is now one of the best performing major assets of 2025. It's up more than 40% year to date. Gold is not far behind, but mining equities still lag, and the central bank bid may be peaking out. So is this the beginning of another breakout for precious metals, or is it another head fake? Joining me right now is one of our regulars, of course. Adrian Day joins us now, of course, founder of Adrian Day Asset Management. Good to see you.
Good to see you, Jeremy. How are you?
Good old Quebec. We got some sun.
Finally. While we're indoors for the conference, we get sun.
Yeah, amen. Okay, so you heard me in the intro there. I'm going to give a little bit more context because there's plenty to get into today. I mean, we got gold almost at $3,400. We got silver past 34 for the first time since early in 2012. And now we got the OECD cutting its growth forecast. We got this trade chaos and, of course, monetary indecision. It almost feels like the investors are a little confused at this macro backdrop, no?
There's certainly an awful lot going on. Yeah. But, as I look around the world at the monetary economic situation, as well as the geopolitical situation, but particularly the monetary situation, it's difficult to think of a scenario that's really gold negative. Fundamentally and long-term gold negative.
Yeah. Are you confident in it this year? I mean, is it just reacting to this trade policy, this dysfunction?
No, that's just almost the icing on the cake. I don't know if that's the right expression for what's going on, but fundamentally, as we know, for the last 3 years, fundamentally, the gold price has been driven by central banks, diversifying their assets in the face of dollar weaponization. That's been the fundamental driver. And then you've had Chinese investors in the last maybe 12 months, 10 months, who've really ramped up their buying in the face of concern about a yuan devaluation and a weakening Chinese economy, and concern about the banking system. So they're not putting money in the bank. They're protecting their assets by buying gold. Neither of these two factors, which have been the main factors driving gold for the last 3 years, are really related to trade, Trump, US, and they're not really related to the macroeconomic environment. They're related to very specific things. I think more recently we've seen more buying come in relating to the fiscal issues. It's not just the US. The US is the US is the most serious, because it's the reserve currency. But many other countries in the world have fiscal problems as bad as or worse than the US. So, people are beginning to react to that, and how do we get out of this situation? So I think things like, and I don't mean to downplay it, but things like Israel and Gaza and the threat of Iran, nuclear war, boy, yeah. These are just, and tariffs. I think these are sort of, as it were, an icing on a cake. I don't mean to put, that's the wrong expression.
Yeah, it's just helping push it a little bit higher with this.
They're gold positive, but they're not what's fundamentally driving gold.
Let's talk a little bit about those fundamentals. I don't know if you heard, but obviously the World Gold Council came out with a new report, and they're pushing gold as a high-quality liquid asset. ECB is warning that the gold demand itself may destabilize the system, even though it feels like it's a little bit of self-preservation at that point, right?
Yes. No, when I heard that, I thought, yeah, they would say that, wouldn't they? Look, let's face it, if you look at the last 10 years, this is an astonishing fact. Yeah. Gold has been the least volatile asset of any. The stock market, the bond market, certainly crypto, foreign stock markets, currencies, the dollar even. They've all been more volatile than gold. And so what you want as a reserve asset and what you want as a liquid asset for banks is a non-volatile asset. So, no, gold to me is the ideal asset for that function.
You know, it's interesting. I mean, they also came out with this report today talking about central bank demand. I mean, the central banks are still buying, albeit a bit slower. Central banks bought about 12 tons in April. That's the second consecutive slower accumulation. I'm curious when we talk about, it becoming this liquid asset. I mean, is it going to start competing with sovereign bonds as collateral?
I think so, absolutely. It's going to start competing with sovereign bonds, and particularly with the US dollar, of course, because for various reasons, many foreign governments don't want or are less keen, let's say, on US bonds than they were. But frankly, it's not just US bonds. US bonds have their own particular difficulties. But really, long-term bonds of most countries around the world are simply not attractive right now. I mean, they're just not attractive. So the only people who would be buying, let's just say US right now, I mean, the only people who would want to buy a 30-year US bond at, less than 5% are people with long-term liabilities like pension funds and insurance companies. Yeah. But an investor, would you buy a US bond for 30 years and hold it? Of course not. And expect to make money? Yeah. Of course not. And that's true for many countries around the world. So I think gold is the ideal asset. I'm not overly concerned about, it's to be expected. And I think we've mentioned this before, that the buying from central banks would slow the pace of growth. It's been the rise from really 2020, 2022 particularly, and then, has been so dramatic. But if you look at the buying for the first quarter, we only have the first quarter numbers, and then we have April's numbers. It's still well above where it was in the teens and the O's. Whatever you call them.
Yeah.
Autos.
Yeah, autos. I mean, we've been talking about these all new time high. I've been reporting on this a long time. Does the stress in the long bond market create a new super cycle for gold?
I think that's one of the most compelling factors coming up. Mm-hmm. If the U.S. has here's what I think is going to happen. Although here's what I think could happen. The U.S., we all know, is having difficulty funding its deficit, and it's doing it increasingly at the short end. I don't criticize Besson for that because he was handed basically an empty treasury. And in fact, Janet Yellen on a Friday night interview on January the 19th or whatever, before Trump was sworn in on the Monday, said, I can't remember the quote exactly, but it was basically, there's no more money. Oh, that's right. She said the Treasury is likely to default by Tuesday. Thank you very much.
Yeah, good luck.
And so I don't criticize Besant for this. He has to fund at the short end because to fund at the long end would mean significantly higher rates at this point. People would demand higher rates. But we've got the debt ceiling issue, which is a whole different subject, but we got the debt issue, and everybody, including Besant, including the Treasury, say that by the end of summer, the U.S. is going to run out of money. And so, I think if that comes to a head, the U.S. isn't going to default, but something's going to happen. So I think what's going to happen is that the Fed is going to institute QE again. Now, that's not an original idea for me.
September?
Although I claim it I think by the end of summer, September, they're going to be QE again. They may not call it QE, but we'll have QE. And I think QE is much more likely than dramatic interest rate cuts, frankly, because the concern right now is not the job market, which would mean you want to do rate cuts. The concern right now is the funding of the federal government, which means QE. Rate cuts don't do much for funding the U.S. government.
Yeah, and of course you have that new spending bill just adding to the deficit that just passed as well.
Yeah. Well, I think there's obviously going to be, I wouldn't be surprised if it doesn't pass. It's not going to pass the Senate, in my view, in the current state. Now, there's going to be backwards and forwards. It's a tough situation because the more you give on this, then there's other people in the House who say, well, we don't like that. But you're right. I mean, it's extending the tax cuts, which I think is a good idea. Always and everywhere, I'm in favor of lower taxes, but particularly with the economy the way it is, lower taxes is a good idea. There's some cuts that are good, but overall, it's just boosting spending.
Yeah, and of course that record debt continuing to pile on.
With a promise that we'll cut spending next year, don't worry.
Everybody does.
Yeah.
Everybody does. Okay, I have to ask you about mining valuations. Obviously, we're here at this conference, and the miners are, having some record margins, but they still trade like distressed assets. So let's talk a little bit about this. I mean, is it passive flows? Is it people putting cyclical bids in here? A jurisdictional risk? I mean, what's happening to the miners right now in this market?
No, good question. I think the big issue is that we talked earlier about the central banks and the Chinese consumers who are buying for particular reasons, but what they're not buying for is because of the macroeconomic environment, right? So typically, when the economy is seemingly strong, inflation is low, interest rates are high, the dollar is strong, that's not a conducive environment for buying gold. And so for ordinary retail people, I don't mean as a defensive asset, but an ordinary investor, that's not the environment which is attractive to gold. And that's really been the environment that we've had for the last several years. Yes, we had the weak GDP numbers, but there were all sorts of excuses about that, and it was just brushed off. Now, when you come to the stocks, you add another factor to that. When the S&P and the TSX are going up month after month after month, you don't look for other things to invest in. So what I suspect, and we're beginning to see cracks in the economy right now, right? I mean, it's pretty clear in the US that the economy's slowing. Retail sales are only being held up by high credit card debt, so that's unsustainable. Jobless in the US, new jobs creation numbers are high, but literally a majority of the new jobs created are either government or part-time, so that's not healthy. So we're beginning to see these cracks in the economy. Interest rates, they're going to have to cut them at some point, and the dollar is, let's say, volatile.
Yeah, to say the least.
So we're beginning to see the macroeconomic environment for gold turn more positive. And I suspect what we're going to see when the stock market, when the erstwhile leaders start to falter, they don't have to collapse, just falter, people are going to start looking elsewhere. We saw this in January, February, when Nvidia and Microsoft and Tesla had their big drops, and money started flowing into European equities. So I think we're going to start seeing people look for other places to put their money. It might be European equities or global markets. It might be emerging markets. It might be small cap. It might be value, which is grossly underperformed. Right. Defensive stocks, income stocks. But one of the areas which is underperformed where people will look are commodity stocks, and particularly gold stocks. So I think that's what we're going to see when the macroeconomic environment shifts and the stock market shifts. And one last thing about the stock market, if I may. One thing that I don't think has been focused on enough is the amount of money from overseas that has been pouring into the US stock market month after month after month in the equivalent of the 401ks, just automatic, passive investing into the US stock market. Now, when President Trump, and I had to say the word, I'm sorry, when President Trump, when the administration in effect, makes it clear to foreigners, we really don't want your money. The dollar's going to get weaker. We don't really care about the stock market, and we don't really like you anyway. That money at some point is going to stop flowing into the US.
Yeah, what does that mean for the 401s?
It's very, very significant because it's about 20% of the flows into the US are coming from abroad.
Wow, and a lot of retirement savings in that as well, I would assume.
Yeah. Just automatic rollover,
ETF buy.
and that's going to change.
Okay, well, let's talk about the developers. I mean, they're less than 0.4%, 0.4 times NAV. I mean, the majors are really re-rating here.
Right.
Let's talk a little bit about what investors need to see. Is it M&A? Is it a Fed cut?
Well, two things. Well, probably more than two, but two things. First of all, I think the valuations on the seniors, by and large, are still good.
Yeah.
They're still good value. And, you know, as Oscar Wilde said, there's people who don't know the difference between price and value. The prices are good. They've gone up, 45% in the last 12 months. Yeah, something like that.
Good little run.
44% in the last 12 months. Nothing to sneeze at, as we say. I don't know if you say that in Canada, but anyway.
They do.
Okay. But the valuations are still low. You look at Barrick, obviously has its own problems, but Barrick's trading in its lowest decile of price to NAV in its entire history. And it's had political risk for quite a long time. It's had other risks for quite a long time. Agnico, obviously the la creme de la creme, is trading in the lowest 20 percentile, if that's a word, the lowest 20% of its 40-year history in terms of price to cash flow.
With the highest margins ever.
So these valuations are very cheap. As you say, the lower down the food chain you go, then the better the valuations become. What's going to change it, I think first of all it's the macro environment. The macroeconomic environment will change to where people want to buy gold for what I'll call traditional reasons. Right, which is, lower interest rates, higher inflation, weaker dollar, softer economy. That's the macroeconomic environment that makes people turn to gold. Yeah. And when the stock market, as I say, whatever word you want to use, rolls over, runs out of steam. When you open your statement, whether it's email or I had a picture of people opening envelopes. They don't do that anymore, when do they? But when you open your statement every month and it's not going up every month, then you start to think about somewhere else to put it. Yeah. So I think that is what's going to change it. Now, the wide margins and the increasing margins, which translates to increasing free cash flow quarter after quarter, that's beginning to get interest from value investors. Because there's no other sector in the US, certainly in the US, there's no other industry sector with such high growth in cash flow as the gold mining sector.
Well, and you brought up, a lot of retail investors waiting for that, a lot of the miners waiting for that inflow as well. I got to ask you, you brought up Barrick, obviously, in Mali, and it's about 10% of its production. It's offline again. It just came out this morning. The arrest warrant still stands. There's about 1.2 billion that's frozen there. Government wants a new mining code applied retroactively. So, do you buy the risk or do you walk away?
Good question. I would think that Barrick's stock price right now is fully discounting Mali. So I when it comes to Barrick, I would buy the risk. Clearly there's something going on in Mali. It appears to be some disgruntled former high-level employees, Malian employees who, are pushing the government's policy on this. Yeah. And of course, there's a big black eye for Bristow because Bristow has a reputation of being able to deal with these sovereign risk issues. I think it's fully discounted in the stock price right now, frankly.
Yeah, and it doesn't feel like it's going much further. But I mean, it does bring me to the next point about this type of risk in the market. I mean, Agnico, Alamos, they're being rewarded for being in safer jurisdictions, obviously. Is jurisdictional risk now underpriced, or is it overpriced, you think?
No, I don't think it's underpriced at all. I mean, I've always thought, I know there's some people who love to embrace the political risk, and it is all a matter of price, of course, and risk reward. You might have a 50% risk of your mine being confiscated, but if your reward potential is 100 to 1, maybe you're willing to take the risk. But there are some people that embrace that risk. My thinking always is that there's enough risk in the mining business, natural risk, technical risk, and so on. There's enough risk in the mining business without deliberately searching out geopolitical risk, which you can't really do anything about, because once you've put those billions of dollars into exploration, development, and building a mine, you're stuck. It's there. You can't just say, well, Mali, you don't want us, we're going to pick up our mine and go next door.
Yeah.
So I just think there's enough risk without taking that on.
Yeah, well said. Okay, I mean, the context here is obviously juniors are still struggling to raise some capital in this market. The producers are being somewhat ignored, and royalties, some are saying, are quite expensive at these rates. So which model gives you the best upside to risk right now?
Yeah, I don't think royalty companies are overvalued at all. Yeah. The valuations are rich. Ben Graham, Graham of Graham and Dodd fame, Ben Graham would probably walk away, or he'd probably run away from the royalty companies. But they sport high valuations for a reason, for a very good reason, and that is the business model is a very, very low risk business model. So as a foundation of if I were new to the sector today, just brand new, I just inherited some money, whatever, I would definitely buy the best of the royalty companies as a foundation of my portfolio. Things like Franco and Wheaton, gosh, even at today's price.
Yeah, it's
maybe.
Wild. Randy, he'll be coming on soon. Yeah.
Oh, well, tell him I said I would buy it, even at today's price.
Even at today's price.
But, the thing about the royalty companies that people really misunderstand, they think that the royalty companies are great for a bear market. They hold up better. But in a bull market, they don't give you the leverage. For royalty companies, and by royalty, I mean royalty and streamers, the royalty companies have plenty of leverage. Not only, of course, does their revenue go up with the stock price, with the gold price, without any extra capital, but typically when you create a royalty or stream, I'm not talking about the legacy royalties that people buy, like Franco's on Goldstrike, but when you create a royalty, the royalty companies are very, very careful to get as much of the surrounding ground as they possibly can, so that when the mine runs out and there's brownfields exploration, they're still exposed to that. And think about it, they're buying a royalty or a stream. They're buying a stream today on a particular asset. The mine is in life for 5, 7, 10 years. Then it starts brownfields exploration, and then it starts developing those ounces and bringing them into production. And the royalty or streaming company gets rewarded for that without spending an extra penny. Now, I don't know what you call that, but I call that leverage.
Yeah.
So I think they're a great foundation of a company, of a portfolio.
Yeah, and of course you're seeing it today. I mean, Franco just closed that $600 million Lamb Gold deal. M&A starts to be, I mean, it's the only place I think some of these senior producers can actually look to is the juniors at this point.
I think that's absolutely right. And there's a lot of juniors. We've had a bit of a weeding out. In my view, not enough. Yeah. There's still too many walking wounded, or walking dead, I guess would be a better way of putting it. But I think there's been a bit of a sort of weeding out in this sector. There's a lot of good people that are reasonably financed, doing really good work, and making some discoveries. But, good discoveries are few and far between, as we know. But the seniors have to look there, and we're seeing it increasingly. So, yeah, I think we're going to see increased G&A, and we're going to see all types of G&A. Will we see another mega merger like, Newmont and Newcrest, or Barrick and Randgold, that was a few years ago. Maybe not, but or Agnico and Kirkland, for example. There's always things like that are going to come up, but I think more likely in the near term, we're going to see mid-tiers, intermediates, do mergers, like Equinox and Calibre, that sort of thing.
Which was a beautiful acquisition. It just closed, too. I think everybody's happy about that.
That was on our Tinder call.
That was on our Tinder call. Okay, I have to ask you outside of gold, if we come out, I mean, where else are you looking? I mean, PGMs are a little bit underloved at this market. Uranium is in the headlines right now. I don't know if you saw today, but Meta, Facebook's owner, is going to be buying, nuclear energy from Constellation. Obviously, that price stock is up. What's your thoughts on the uranium and nuclear play? Is it uranium producers? Is it nuclear producers?
There are people far better, far more knowledgeable than I about the individual stocks. So I tend to stick with physical uranium, like the Uranium Trust, the Sprott Uranium Trust, and the major producers like Cameco, even Kazatomprom, which we know will do well. And then we're buying a few of the near-term, the developers, near-term producers in the US and in Canada. I'm not really getting into a lot of the exploration companies. I don't know them well enough, but I'm also a bit concerned that even with all of the new regulatory push, deregulation push in the US,
that executive order,
there's going to, which is very powerful, very powerful. I mean, just think, they actually put a mining guy in charge. Can you believe it?
I know.
Wow. Whatever next? There's always going to be local opposition to a uranium mine in your backyard, always. And so things are going to be a bit slower. But I mean, I think the story is very powerful and it's got multi-years ahead of it. Copper, I like copper a lot.
I was going to ask you because, I mean, copper's kind of flat, and we're learning that the demand needs to be, or we need about double of what we have right now with this whole energy transition. Is that priced in or not even close?
I mean, my argument for copper was never based on energy transition, because I always thought the projections of demand from energy transition, particularly from EVs, was probably overdone. But unless the global economy goes into a serious slowdown, particularly China, which is not unlikely, but we don't need any demand from electrification for copper to be in a shortage in 5 years. The thing about copper is it has a very, very long lead time, and so you can see with reasonable certainty what the supply in 5 years' time is, even 10 years. You can really see it. That's not really true of, say, gold or silver, where you can have a small mine that comes into production, a bit quicker than that. But there's not going to be a major source of copper in 10 years we don't already know about. And so unless the world economy moves into a global recession, starting in 5, 6, 7 years, we're going to start having a deficit in copper. And we're just not building enough copper right now.
You sound like Friedland.
Well, I wish I could talk like him, that's for sure.
Yeah. Okay, I got to ask you, before we let you go here, I mean, obviously we're at this conference. Let's do some rapid fire questions. Quick answers. Are you ready? It's not quite like the Tinder dating segment we did back at PDAC, but your year-end gold target, I mean, is it above or below 3,500?
Oh, above?
Yeah.
Ridiculous.
Yeah.
What a question.
Just waiting. Where's it going?
Well, you didn't ask me that. You asked. No, I wouldn't be, I'm not one of these wild-eyed people, but I think 45 to 5 is not unrealistic.
Yeah. Well, not with these, it's on its way there now.
Yeah.
Okay, most mispriced senior miner right now?
Most mispriced. Oh, you should have asked me to think about that. Most mispriced senior. They're all priced for a reason. Yeah. So probably, I could say Barrick, but it's priced where it is for a reason.
Yeah, especially with that.
But I would
risk.
say Barrick because I think the negative is realized, but the potential positive is not.
Junior, you would own at the current NAV.
Junior, I would own at the current NAV. Oh, several.
Yeah.
That's easy. I mean, Origin, which of course has been taken over by Triple Flag, so everybody says, boring, and I was in it 6 months ago and I've sold it and that kind of stuff. But it's still trading at a lower price than the takeover price. So I think you have virtually no downside. There's always down, but virtually no downside. And unless gold collapses and the Triple Flag price collapses, you've got certain upside. Not huge upside, but certain upside. I'd buy that one, but there's several. I mean,
one more, you got to give it. Audience loves this, Adrian. They love a good stock pick.
I'll start it with A alphabetically. So, if your stock begins with T, I apologize. That's the reason I didn't mention you. Orion. I think Orion is very good value. I think is being very well run. We know that they're in a little bit of a holding pattern. Obviously, rapid fire, aren't they? Yeah. They're in a holding pattern now because they basically got a veto on the ground that Rupert really needs, even though they pretend they don't, the layback. They need for their layback. It's a B2 Orion joint venture, but B2 is the senior partner, but Orion essentially has a veto on transacting, and Rupert's got to transact with Orion.
Interesting. That's an interesting one.
Well, yeah, and Orion's Rupert has gone ahead with the feasibility, with the mine plan, and now they're going ahead with permitting applications without the layback. But everybody knows at some point they're going to need that layback. And the longer they wait, the more expensive it's going to get, I think.
Yeah, well said. Okay, one sector to hold through next year, 2026. We talked about that macro. We talked about the executive order on uranium. Is it something like uranium? Is it bullion? Is it miners?
I would definitely hold the gold mining stocks through next year. No question.
Yeah. Just getting going.
And uranium as well, yeah.
Okay, yeah. SMRs, you look at that technology, you're more into the physical.
I'm more, yeah.
All right, you heard it here. I like it. Adrian Day, of course, founder of Adrian Day Asset Management. Hey, thanks, man. This has always been great. Great to see you here in Quebec.
Thank you.
Appreciate it. I'm Jeremy Saffron for all of us here at Kitco News. Be sure to follow along, like it, subscribe, all that good stuff. We're going to have some great guests coming up all week long here in beautiful Quebec City. We'll see you next time.
Kitco News special coverage of the Mining Investment Event of the North is brought to you by West Red Lake Gold Mines.